this lesson, we are going to focus on quiz 2 from learning unit 3. Okay, so this is what you'll need before you can proceed. Go back to your study guide and open page 52. You will get the table which has separated assets, equity, and liabilities into different columns. Okay, once you found this, you can continue with this lesson. Okay, so as you can see, the first two attempts, the student got 0, and now we are going to reattempt the quiz. Okay. Okay. So once you have opened this quiz, you'll notice that you have this table to fill here. So basically what they want is for you to indicate which account must be debited and which account must be credited, and then state whether an asset, equity, or liability will increase. Okay. So if it results in the decrease of whatever element here, you will use a negative sign to indicate that. Okay. So let us read the questions. Mr. Moleleng runs a small stationery business, Day Traders. The entity is not registered as a VAT vendor and uses a perpetual inventory control system. When using the perpetual inventory system, all inventory purchase is recorded in the inventory account, and when it is sold, the cost price of the inventory is recorded in the cost of sales account and the inventory account. You will learn more about the topic in learning unit 6 and 7. A markup percentage of 20% on cost is applicable. The following transactions by day traders took place during January 2022. Okay, so now that we have read the instructions, let us try to complete the table. Okay, so these are the transactions that took place. Okay, on the 4th of January, the entity purchased stationery for resale from large wholesalers on credit for 5,000. Okay, if you purchase stationery for resale from large wholesalers on credit, you are basically purchasing inventory. Okay, so what happens when you purchase inventory? Okay, remember, you're purchasing inventory on credit. Okay, you will need to go back to your table and identify whether inventory is an asset, equity, or liability. If you search here, you should be able to get inventory. Okay, so trading inventory. Okay, we have identified that trading inventory is an asset. So when you buy an asset, what are you supposed to do? When you buy an asset, you are supposed to debit that asset. Okay, so here the account to be debited is the inventory account. Okay, remember, inventory is an asset. The account to be credited, remember, we bought this on credit. Okay, so this is what trade payables control. So remember, in the previous lesson we discussed what a trade payables control is. Okay, so this is basically what you're supposed to do. It's called trade payables because you are supposed to pay back the money. Okay, so now we know which account must be debited and which account must be credited. The next thing that we're supposed to do is to indicate whether an asset will increase or decrease. Okay, so we are going to have an increase in terms of assets. Okay, we now have more stock in our position, but we also have an increase in terms of our liabilities. Okay, so we must pay back the money. Trade payables is a liability. Okay, nothing is going to happen in terms of our equity, so we're basically done with the first transaction. Okay, so now let us look at the next transaction. Okay, so on the 10th of January, the company paid the Carriage on purchases for the stationery purchase on the 4th of January 2022 with an electronic fund transfer. Okay, the cost was 62 rands. Okay, so whenever you pay transportation fees, that money is part of the cost of the inventory. Okay, so basically remember, inventory is an asset. So even in this case, the additional fees to purchase this asset must be accounted for under the inventory account. Okay, so basically what is going to happen is that we are going to increase, we are still going to use the inventory account here, because the money goes towards inventory. Okay, so these are additional costs for inventory, and we are also going to credit this money to the bank account. Okay, so the money left from the bank account to inventory. Okay, so these two are both assets. One of them is increasing, this one inventory is increasing, and the other one is decreasing. Okay, so this is what we are going to do. We are going to have plus, okay, 62, and then minus 62. Okay, and nothing is going to happen in terms of our equity, and also nothing is going to happen in terms of our liabilities. Okay, so you are basically done with this transaction here. As you can see here, I've just lost my internet, but don't worry, this is not going to deter us from what we are supposed to do. Okay, let's read the next instruction or transaction. Okay, on the 12th of January, the company purchased stationery receipt books to be used by the entity and paid with an electronic fund transfer. This one cost 120. In this case, you see the stationery is something that is going to be used by the entity on their day-to-day transaction. This is not inventory. Okay, inventory is something that is used for resale. Okay, but this one here, because it's supposed to be used by the company, it's not inventory. So that is a very important distinction between these two. Okay, so let us go to our table and search for stationery. If you search here, you'll find stationery. Okay, these are basically expenses. Okay, so whenever you spend money on expenses, you're supposed to debit that expenses account and then credit whatever was used to actually purchase those expenses. Okay, so in this case, they told us that they purchased stationery to be used by the entity and paid with an electronic fund transfer. Whenever you use an electronic fund transfer, you are using your bank account. Okay, so let's go to our table. So this is what it means. Okay, we need to credit the bank because the money comes from the bank, and the bank is an asset. So when an asset decreases, we are supposed to credit, okay, that asset account. And when your expenses are paid off, we need to debit that expenses account, and in this case we are referring to our stationery expenses. Okay, so this is what is going to happen under assets, which is your bank in this case. This one will reduce by 120 rands. Okay, and your equity will also reduce by 120 rand. So whenever you spend money on expenses, you reduce your equity, and your liabilities will be zero. It's not affected. Okay, in this case. Okay, now that we are done with this one, let us read the next instruction. Okay,